Picture an asset, right, that has lost literally 99.7% of its value since the day it was created.
Oh, wow. Yeah, that's brutal.
Right. Over the last year alone, it has plummeted another 63%. I mean, the long-term chart just looks like a black diamond ski slope.
It really does. It's
Yeah.
just a structural collapse.
Exactly. And yet, if you look at it this morning, it is trading tens of millions of shares. Short-term technical indicators are suddenly flashing these massive bright green buy signals.
Right, the volume is completely surging.
It's crazy. So we are looking at the Direxion Daily, S&P, Oil and Gas XPA, and PROD, Bear 2X shares.
Better known by its ticker, DRIP.
Yes, DRIP. So the main question we are putting to you today is this sudden momentum a genuinely undervalued opportunity right now? Or are retail traders walking directly into a notoriously complex value trap?
I mean, it is one of the most fascinating paradoxes in the modern market, honestly.
It really is.
Because you have this long-term fundamental chart that screams structural collapse, right? But then the immediate real-time momentum is undeniably shifting upward. And the danger, the danger lies in conflating those two timelines.
And that timeline disconnect is exactly what we are untangling today in this deep dive. We're going to rip open DRIP's financials, dissect its wild price history, and, scrutinize the underlying technical analysis.
Plus, we'll break down the fierce bull versus bear debate that's happening right now.
Absolutely. And since you are diving into this with us, consider this your official entry ticket. You need to like this video, subscribe to our YouTube channel, and honestly, leaving your feedback in the comments is completely compulsory today.
Yeah, we really want to know where you stand on this debate.
For sure.
But just to set the parameters of our analysis before we jump in, we are strictly examining the provided market data, the sources, and the structural mechanics of this fund.
All right.
We are just exploring the underlying logic of the market here, which means absolutely no financial advice is being given.
Okay, let's unpack this. Let's get straight into the anatomy of this thing. Because whenever I evaluate an asset, my first instinct is to look for the big three financials,
Of course, the traditional stuff.
Right. I want to pull up the quarterly and annual income statements.
Yeah.
I want to see the balance sheet to check their debt to equity.
Yeah.
And I definitely want to look at the cash flow statement to see actual operating revenue. But when you pull up DRP's traditional corporate financials, you just hit a brick wall.
You really do.
There are no gross margins. There's no physical inventory. I mean, it operates in the oil and gas sector, but it doesn't actually own a single drill bit or like a barrel of crude.
Right, because treating DRP like a traditional business is, it's the first major mistake a traders make.
Interesting.
Yeah, DRP is a derivative-based leveraged ETF. It's a financial synthetic.
A synthetic?
Exactly. Specifically, it's an inverse fund designed to provide negative 200% or negative 2x of the daily performance of the S&P Oil and Gas Exploration and Production Select Industry Index.
Okay, so it is essentially a funhouse mirror.
That's a great way to put it, yeah.
Like the underlying index goes up 1% today, DRP goes down 2%.
Right.
The underlying index drops 2%. DREP theoretically goes up 4%.
Mathematically, yes.
But I want to linger on the balance sheet for a second because this is where the illusion really breaks down for me.
Okay, let's look at it.
If I look at the net assets, which the sources say are roughly $97 to $104 million, what is actually sitting in that account if not shares of oil companies?
Well, it's total return swaps and collateral.
Swaps?
Yeah. Instead of buying equity in oil companies, the fund's managers go to major global banks and enter into swap agreements.
So just paperwork.
Essentially, yeah. A swap is simply a contract. The fund agrees to pay the bank a fee, and in exchange, the bank agrees to pay the fund a return based on the inverse performance of that oil index.
Okay.
So if the index drops, the bank pays DRB. If the index rises, DRB pays the bank.
Got it. But what about the collateral part?
Right. To ensure DRP can actually pay out if the market goes against them, they have to hold massive amounts of collateral in their accounts. Ah, okay. And that collateral explains one of the most bizarre metrics in the source material.
The dividend.
Yes. We are looking at a derivative product, yet it boasts a trailing 12-month dividend yield of 4.24%.
I know, it sounds crazy.
With the latest payout sitting at roughly $0.027 in late March 2026.
Right.
If a synthetic fund has no operating cash flow from selling a product, I mean, that dividend isn't a share of profits, right?
Not at all.
It's basically like placing a highly specific, leveraged side bet at a casino rather than buying a share of a business.
So where's the cash coming from?
It is literally just the interest generated by the Treasury bills sitting in the vault acting as collateral for those swaps.
Wait, really? That's it?
That is the hidden engine of the yield, yeah.
Mm-hmm.
In an environment where short-term government debt pays a decent interest rate, that cash collateral generates real income.
Oh, wow.
And the fund just distributes that generated interest to shareholders. But you have to weigh that yield against the operational friction.
The fees.
Exactly. The expense ratio here is a steep 1.01%.
That is high.
Very high. And that fee doesn't just go to a manager picking stocks, you know?
Yeah.
It covers the intense daily institutional cost of rolling over those swap contracts every single trading day.
Which means that 4% dividend is almost like a shiny distraction.
Precisely.
You are paying a premium to maintain a highly specific, leveraged position. So let's look at what that position has actually done to the price.
Let's do it.
As of April 14th, 2026, we are sitting at $5.06. The immediate day range is tight-like, 4.85 to 5.11.
Yeah, fairly narrow for a single day.
But the 52-week spread is violently wide. We're talking a high of $14.31, down to a low of just $3.77.
And that kind of spread over 12 months is indicative of the underlying sector.
How so?
Well, the index DRIP tracks isn't just the massive, stable, integrated oil majors. It includes smaller exploration and production companies.
Oh, the really volatile ones.
Exactly. Those companies are highly sensitive to crude oil prices. When crude prices swing, the index swings, and then DRIP amplifies that swing by a factor of 2.
That makes total sense. And that actually brings us to the core contradiction that is driving the current debate right now.
The recent price action.
Yeah, DRP is down 63.6% over the last year. But if you look at the last few weeks, it is up nearly 34% from its March lows.
That's a massive short-term rally.
Right. And this is where the technical indicators are throwing up major short-term buy signals. But I am, inherently skeptical here.
Fair enough.
I am looking at the 14-day RSI, the Relative Strength Index. On March 31, it crossed above 30, moving out of oversold territory.
Right.
Normally, that suggests a healthy reversal. But given the DRP is synthetically rebalanced every single day, isn't applying a standard momentum oscillator like RSI fundamentally flawed?
What's fascinating here is it is flawed if you're using it to predict long-term intrinsic value.
Okay.
But it is highly revealing if you are using it to read the immediate psychology of the room.
The psychology.
Yeah. Technical indicators on leveraged ETFs don't measure the value of the asset. They measure the velocity of the crowd.
Oh, I see.
So the RSI crossing above 30 simply tells us that the intense algorithmic selling pressure that drove it down to 3.77 has temporarily exhausted itself.
Ah, so the sellers are tired.
Exactly. And new buyers are rushing in fast enough to shift the momentum.
And those new buyers are shifting the moving averages too. Right now, the price is hovering above the 20-day simple moving average, which sits at 4.43.
Yep, that shows short-term strength.
Right, but it is entirely trapped underneath the 50-day moving average of 5.43.
Yes.
That is a heavy ceiling. It's medium-term resistance. So the algorithms and tactical traders are basically playing ping pong between those two levels?
They are mapping the psychological battlegrounds, really. You have immediate support acting as a floor at 4.73 and that historic rock bottom support at 3.77.
Right, the absolute floor.
And on the upside, breaking the current 5.11 level means the next immediate test is that 5.43 ceiling. The traders operating in this space are looking for any catalyst to push it through that resistance.
Speaking of catalysts, the source material highlights a very specific signal with the MACD, the moving average convergence divergence.
Ah, the MACD crossover.
Yeah, it turned positive on March 31st. And the sources cite this statistic claiming that historically, this specific MCD signal for DRAP has preceded further gains in 90% of past cases.
90%.
90% never feels dangerously high to me.
It does sound like a lot.
I mean, in a market dictated by global oil supply, a technical indicator having a 90% win rate sounds like a statistical anomaly, not a guarantee.
Well, the skepticism is absolutely warranted because that statistic lacks structural context.
What do you mean?
A MACD crossover simply means short-term momentum is accelerating faster than long-term momentum. But you have to ask, who is driving that momentum?
The volume is huge.
Exactly. Look at the trading volume. We are seeing anywhere from 32 million to 57 million shares changing hands daily.
That's massive.
It is. And the participants here are not fundamental retail investors putting $5 shares into a retirement account because they think the company is undervalued.
No, they're institutional traders and sophisticated speculators.
Spot on.
They're looking at the real-world macro data. Like in early April, record oil supply data hit the market.
Right, the supply glut.
Exactly. And oversupply means cheaper crude, which means the underlying oil exploration stocks get hit hard.
Yes.
So those institutions are using DREP to hedge their massive energy portfolios against that specific supply glut.
If we connect this to the bigger picture, they step in, ride the 2x inverse wave for a few days to offset the losses in their long portfolios, and then they exit.
Just a quick trade.
Exactly. That institutional influx is what triggers your Mankey crossover and drives that massive volume. It functions perfectly as an inverse shock absorber for a very brief window of time.
Okay, let's expand on that brief window of time, because this is where retail investors just get slaughtered.
Oh, absolutely.
They see a stock trading at 5.06. They see it just jump 20% in 5 days due to that oil glut, and they think, this is cheap. I'll buy it and hold it until it goes back to its 52-week high of $14.
It's a classic mistake.
Which brings us to the great value trap debate. Is it undervalued or is it a trap?
The $5 price tag is a complete illusion. It doesn't represent cheapness or value. It is merely the current mathematical output of a degrading formula.
A degrading formula.
Yes. The killer mechanism here is volatility decay, which stems directly from the daily reset feature of the swap agreements we discussed earlier.
Here's where it gets really interesting. I want to make this mechanism incredibly clear, because it is the single most important concept in the source material.
It really is.
Holding DRIP for months is not like holding a regular stock. It's like trying to carry water in a bucket with holes in it.
That's a great analogy.
Or like trying to run down an up escalator. But every night at midnight, the escalator stops, measures your progress, and completely resets its speed to match you.
Right. That is the harsh reality of daily compounding. The fund is only obligated to deliver negative 200% of the index's return for a single day.
So one day.
Just one day. When the market opens the next morning, the base mathematical value has shifted. If the underlying oil index is highly volatile, meaning it shocks violently up and down, but ultimately goes nowhere, DRIP will mathematically hemorrhage value over time.
Let's walk through the mechanics of that chop for a second.
Okay.
Say you buy in. The oil index drops. Your DRP shares spike. You are feeling brilliant.
Right. You're up.
But the next day, the oil index rebounds back to its original starting point. Over a 48-hour period, the fundamental asset has essentially experienced 0% change.
Exactly.
But because DRIP has to recalibrate its negative 2x leverage off the new, higher base from day one, that day two drop is mathematically larger than the day one gain.
The compounding friction burns your capital. The underlying index went sideways, but you lost a significant percentage of your investment.
Wow.
Add in the 1.01% expense ratio, add in the bid-ask spreads on the daily swap rollovers, and the structural integrity of the asset simply melts.
It just disappears.
This is why, over a long enough timeline in a volatile market, the value of this fund approaches zero.
And the sources confirm that decay with brutal clarity. Since its inception, DRIP is down 99.7%.
It's staggering.
The management constantly has to enact reverse stock splits just to keep the share price above exchange delisting requirements.
Yes, they do it all the time.
So the current 5.06 price is just a temporary waypoint on a downward trajectory.
Which is why the sentiment surrounding this asset remains strictly neutral to cautious, despite those flashing green buy signals on the daily chart.
Right. Knowing this escalator only goes down in the long run, how do the analysts and the sources reconcile the bull and bear cases for its immediate future?
Well, it depends on the time frame.
Let's start with the bull case. And just to be clear to you listening, being a quote-unquote bull on DRIP means you are betting on maximum pain for the actual oil industry.
Yes. The bullish scenario for DRIP over the coming weeks requires the fundamental macroeconomic catalyst to intensify.
So more supply.
Exactly. The bulls are looking at global crude inventories. If the supply glut continues to build and storage facilities start filling up faster than demand can drain them, the entire energy sector will face sustained downward pricing pressure.
Under that scenario, the recent 34% bounce from the lows isn't just a dead cat bounce. It is the beginning of a tactical trend.
Right.
If oil exploration companies are cutting guidance and shrinking margins, DRIP's momentum sustains. The 5.43 resistance level gets shattered, and DRIP becomes an incredibly lucrative tactical shield for the short term.
But the bear case against DRIP, meaning the bullish case for the broader oil market, relies on the fragility of global geopolitics.
Geopolitics.
Yeah. The worst case scenario for someone holding DRP at 5.06 today is that the broader long-term downtrend of the ETF violently reasserts itself because of a sudden external shock.
And we are operating in an incredibly volatile geopolitical climate right now.
Absolutely.
You have major producing nations managing output, global supply chains under constant tension, and geopolitical flashpoints that can ignite at a moment's notice.
All it takes is one headline.
Right. An unexpected production cut announced on a Sunday or a sudden escalation in a conflict zone can cause crude oil prices to spike 5 or 10% overnight.
And if that underlying oil index spikes, DRIP gets utterly crushed by its negative 2x multiplier at the opening bell.
Just destroyed immediately.
Because of that leverage, the 20% recovery DRIP experienced over 5 days could be entirely wiped out in the first 5 minutes of trading.
That is terrifying.
The risk profile is asymmetrical. You are fighting structural decay, and you are constantly exposed to overnight geopolitical gaps.
So what does this all mean? Because this perfectly explains the confusing analyst ratings in the source material.
Yeah, the ratings are all over the place.
Right now, analysts are issuing a very mixed bag of sell and hold ratings on DRIP. At first glance, that seems contradictory. I mean, how could it be a hold if it is structurally designed to go to zero?
It all comes down to the timeline of the mandate. Analysts issuing hold ratings are acknowledging the validity of the daily charts.
The short-term stuff.
Right. The RSI and MACD are indicating short-term momentum, and if you are currently holding it as a hedge against an oil glut, the data suggests holding your ground to see if it tests that 5.43 ceiling.
But the analysts issuing sell or strong sell ratings are looking past the next 2 weeks.
Exactly. They are acknowledging the absolute mathematical reality of leveraged inverse ETFs.
The decay.
Yeah, they are looking at the 99.7% historical drop and warning retail investors that trying to catch a falling knife by holding this for 6 months is basically financial suicide.
They are demanding that traders separate the concept of a cheap stock price from a highly specialized decaying derivative tool.
You have to be precisely right about the direction of the global oil market.
And you have to be precisely right about the timing.
Yes. If the market goes sideways, you lose. If the market goes up, you lose twice as fast.
You don't use a scalpel to chop down an oak tree, and you certainly don't use DRIP for a buy and hold value strategy.
Never.
Let's synthesize exactly what we've uncovered here today. The financials are not based on sales or physical assets. They are an illusion built on institutional swap agreements and treasury collateral.
Right.
The technicals show a sharp, volume-driven short-term reversal, bouncing off historic lows and creating genuine immediate momentum.
The momentum is real.
But the fundamental, inescapable reality of volatility decay makes it an incredibly dangerous long-term trap for anyone not actively managing their position day by day.
It is the ultimate test of trader discipline, honestly. Recognizing a momentum signal is only half the equation.
Right.
Understanding the mechanics of the vehicle you are using to trade that signal is what separates institutional hedgers from trapped retail capital.
Which brings us to a final thought for you to explore on your own. We know the technical indicators, like the RSI, the MACD, are currently pointing to short-term upward momentum for DRP.
They are.
But we also know we live in a world where a single geopolitical headline alert on your phone can instantly rewrite the rules of global oil supply.
In a heartbeat.
So ask yourself, are those green technical indicators actually predicting the future, or are they just telling us a very convincing mathematical story about the past?
In a market driven by global events, historical math is a pretty fragile shield.
Exactly the kind of uncertainty that makes this market so fascinating. Thank you for joining us as we mapped the mechanics and the madness of DRP.
It's been wild.
Now it is your turn. We need you to hit the comments right now. Remember, it is compulsory for today's topic.
Yeah.
Do you think DRP has the momentum to break through that heavy 5.43 resistance ceiling? Or is a geopolitical headline going to send it crashing right back down to its historic lows?
Let us know.
Make sure you like this video, subscribe to our YouTube channel, and we will catch you on the next deep dive.